Hi, it's Neil here, and this is week 2 of International Accounting and Taxation. And again, just so we can slowly go through the step-by-step approach I'll take you through, this recording is about chapter 2 of the textbook, and this is just to help you to supplement your reading and trying to digest some of the information that's in the textbook. So let's get into the good stuff, shall we? We have learning objectives that we want for this week, and let's have a look at some of these learning objectives. One is we want to understand the evidence that is out there of the diversity that exists in accounting internationally. If there was no differences, we probably wouldn't have a course to study on international accounting, right? Because the differences exist, then that has economic consequences for various decisions that different parties make in the organisation. So we want to understand what are some of these differences. We want some evidence of that. We want to explain the problems caused by accounting diversity, and we want to describe the major environmental factors that influence the national accounting systems and lead to accounting diversity. So this is what we're good. This is the good stuff. And we want to describe the major environmental factors that influence national accounting systems and lead to accounting diversity. We want to describe a judgmental classification of countries by financial reporting system, and we want to discuss the influence that culture is thought to have on financial reporting, and to describe a simplified model of the reasons for international differences in financial reporting. And finally, we want to categorize the accounting differences internationally and provide examples of each type of difference. In other words, these learning objectives are framed around what are the reasons for the differences? Is there some way that we can describe the differences that exist? And is there some way that we can classify these differences? And if we can classify them, then we're going to have a better understanding of that. In other words, we're aggregating this massive information out there into a few categories, and by doing that, you have much more confidence in dealing with the differences that you see. So let's get into the good stuff. So we understand that there is accounting diversity, and that diversity is in terms of the format, terminology, recognition rules, and measurement rules. And some examples of the format could be as simple as in the USA, they'll have different balance sheet components where the shareholders' equity and liabilities go together to make the assets. But in other countries, there's assets minus liabilities, and then that is equal to shareholder equity. There's also terminology differences. So in the US, you basically report the consolidated balance sheet, whereas in the UK, the parent's balance sheet will also be reported alongside the subsidiary's balance sheet. And so there's some good examples in chapter 2 of comparing Vodafone and Verizon. So have a look at Vodafone, which is representing a UK company, and Verizon representing a US company. Have a look at the differences in how the balance sheet compares between the two. Recognition rules are different, and also measurement rules are different, and this adds to more complications in trying to compare financial statements from different countries. So let's have a look at the different reasons that are expected to explain the differences we see in worldwide accounting diversity. And the reasons are, there's basically 5 different reasons, and we're going to go through each of them one by one. The first is the legal system. The second is the basis for transaction. The third is providers for financing. The fourth is inflation. And finally, there's the political and economic ties that in some ways actually bring countries together rather than make them to go apart. We'll come back to that shortly. But let's firstly look at the legal system. There are 2 basic legal systems in the world today. There's the common law system, and then there's the code law system. And the common law system is basically, a good example is the US, Canada, and Great Britain, and all of its Commonwealth states. Basically, the Commonwealth are basically all of the countries that Britain colonized back in the last 200 years. And basically, Britain brought their own law system to all of these countries. And that law is really based on legal judgments, cases, and precedent, and not just statute law, which is handed down by the state. Code law systems, in contrast, for example, the non-English speaking countries, Germany is a good example, they have legislated accounting rules, they have legislated laws, they have a lot of statutes. And so therefore, the law, you refer to the statute for working out what you're allowed to do, what you're not allowed to do. In some ways, the accounting rules are governed by the statutes as well. So we call that an accounting law under code law jurisdictions. So the legal systems are different, and because due to the legal system, then the accounting diversity is going to be different, or the way accounting is practiced is different. For example, under common law, the way accounting is practiced is there are different bodies that are separated from the state. For example, the FASB in the US is separated from the state, and they govern the way GAAP, General Accepted Accounting Principles, are employed in US. And so, but if you go to another country, in China, the way the laws are set up are really governed by the state. They're not governed by a separate body. And so the accounting law is aligned with the policies of the state. And so that's the big difference between a common law and a code law type country. And that's where accounting diversity comes about, because of these different legal systems in the different countries. What about a second reason for accounting diversity? The basis for taxation and providers for financing. It's a third reason. Now, the basis for taxation is really interesting. If you go to the US, the way tax income is calculated is totally different from how accounting income is calculated. But if you go to Germany, the same taxable income and accounting income is based on the same calculations. If you go to Australia, taxation income is different from accounting income. And so what happens when the taxable income is different from the accounting income, then in order to reconcile the differences in those states, for example, in the US, in the UK, in Australia, where there are differences between book income, accounting income, and taxable income, we have to make an adjustment in the accounting statements, and we call that a deferred tax liability. And similar accounts are used to account for that difference between the accounting income and the taxable income. But in other countries where it's the same, like in Germany, there is no provision for deferred tax liability. Okay. Or let's have a look at financial statements as we noted here. Let's go on to providers of financing. If we go into the common law countries, that is the Commonwealth, USA, Canada, you'll notice that a lot of the sources of equity, the sources of capital, comes from private providers of financing. It comes from shareholders. It doesn't come from the state. Whereas you go into code law countries, much more of the financing comes from the state. And so therefore, because of the different stakeholders, then they have different demands for what should be reported, how often it should be reported, and the nature of the measurement of accounting and the nature of disclosures. So because the providers of financing is different among code law and common law countries, then you're going to have differences in accounting. What about inflation? Wow. In some countries there's very high inflation, for example in South American countries. At some point in time in Europe there was very high inflation, but very specific in Latin American countries, very high inflation, so they have special accounting rules to deal with the inflation. That is not the case in the US, Canada, and the Commonwealth countries. Again, next, political and economic ties, finally, that's our fifth reason, affect how accounting rules are conveyed. And because the Commonwealth, which is the British Commonwealth, all those countries were colonised by Britain, they tend to practice accounting very similar to Britain or the UK. Whereas other countries outside of that Commonwealth will practice accounting differently. So basically what I've taken you through is 5 different reasons for why we get differences in accounting. The legal system, the basis for taxation, providers of finance, inflation, and whether you have close political and economic ties. And all of these reasons are kind of related anyway. So the Commonwealth countries, they have the same legal system and they also have the same political and economic ties. And in some ways they also have the same type of providers for financing, that is private providers of financing. Whereas you go to China, the legal system is different, dictated by the state. The basis for taxation is similar to accounting, so you don't have provision for deferred taxation. Providers of financing, up until now, it's been dominated by the state still, and they don't have political economic ties with other countries, so they're actually developing their own accounting system. They are adopting IFRS in their own way, which is different from how other countries are adopting IFRS. So as you can see, these reasons are related, and it's not like they're 5 distinct reasons, but it helps you to actually peel apart why we get differences between the different countries. Okay, what about the problems caused by accounting diversity? Well, there are 4 problems here. Problems in preparation of consolidated financial statements, access to foreign capital markets, comparability of financial statements, and the lack of high quality accounting information. Let's have a look at the first one. Preparation of consolidated financial statements. Very interesting here. The problems are really due to local regulations or local currency that has to be translated, the local accounting principles that may be different from where you're listed if you're listed in another country. Therefore, it requires considerable effort, additional costs, expertise in different countries' accounting standards. Let's have a look at the next problem caused by accounting diversity. Access to foreign capital markets. Very interesting story or case in Chapter 2 of Daimler-Benz. That was the first German company to list on NYSE, that is the New York Stock Exchange. Very interestingly, in preparation for that listing, they invested over $60 million in order to get listed. $60 million. That's just administration. That is non-value added. Not $1 of that 60 million went into making a car, which is what they're famous for. It went into administration, accounting, right? Went to the accountants. Okay. Then they realized that every year after listing, they're spending between 15 and 20 million US just to report, just to disclose, just to maintain that listing presence in the USA. So access to foreign capital markets, very expensive. It's not cheap. And this is partly caused by the accounting diversity, because the US has very strict rules which are different from the way Germany requires companies to report. Let's have a look at our next one, the comparability of financial statements. Because of this diversity, there's a lack of comparability between financial statements from different countries. And this affects investment decisions, lending decisions, performance analysis, foreign acquisition decision. For example, if you were to work out whether you're going to invest in a company in another country, or merger and acquisition, you're going to acquire this company in another country, first of all you need to work out, okay, what how are they accounting for the receivables? How are they accounting for the inventory? How are they accounting for sales? You need to do due diligence on just about every part of the accounting. But not only that, then you're going to have to work out what is the foreign currency risk, what is the translation of these figures, what is the real value of that company. So lots of translation has to be undertaken, there's lots of due diligence has to be undertaken, and so because there's a lack of direct comparability of financial statements. They're all different, and this is what accounting diversity causes, and this is why IFRS has been put together to try and bring a bit more convergence between the countries around the world. Yet there's still going to be issues with making sure you're doing your due diligence of any acquisition you do in any country. Let's have a look at our final one, the lack of high quality accounting information. Okay, we can understand that in very developed countries, we're going to have certain level of high quality accounting information. But once we go to more developing countries, like the BRIC countries, we're talking about China, Brazil, we're talking about Russia, okay? In these, and India, we're talking about these countries are still developing in terms of full disclosure, full transparency, full governance in terms of corporate governance that allows that accounting number to really truly reflect what is actually happening economically for that country, for that company. And so because of these, there are differences in these systems. They're developing, the corporate governance rules are different, we get different levels of quality in the accounting information. Again, we've got to go back and do our due diligence if we're going to invest in a developing country, for example. But as you can see in this PowerPoint before you, there's a lack of high quality accounting standards in most countries around the world, inadequate risk assessment, the lack of appropriate disclosure requirements, and there's various disclosure deficiencies, as I explained, because of the different levels of quality in corporate governance. There's a high exposure to foreign exchange risk, related party transactions, investments in highly speculative assets, contingent liabilities guaranteeing foreign currency loans, and loan loss provisions. Okay, so what we've done so far is looked at, we've got that case, yes, there is accounting diversity around the world. There are differences from country to country. And then we looked at, okay, here are the reasons for accounting diversity. The legal system, the basis for transaction, because the providers of financing are different, because of inflation, or is it because of political and economic ties? There's lots of differences for the diversity in accounting around the world. Next, we looked at, okay, here are the problems caused by accounting diversity. And so there are problems in administration, there's problems in comparing financial statements, and there's a problem in assurance of having the same level of quality of accounting information. So we've got diversity, there are reasons for this diversity, and there are problems caused by diversity. And I think what Chapter 2 is actually presenting to you is they're setting this up of this accounting diversity. We need to understand the accounting diversity in a much better way. Is there some system, is there some categorization or way in which we can aggregate all this information about differences in accounting around the world? And that's what the last third of Chapter 2 looks at. And we batch this under this term called accounting clusters.